You've seen the posts, the luxury cars, first-class flights, and five-figure watches. For a while, you might have believed that's what wealth looks like. But the people who actually make up the top 1%, the ones with real, lasting money, play a very different game. And they play it quietly. They don't measure wealth in what's spent. They measure it in what's owned. And the rules they follow? They're often the exact opposite of what most people assume. There are 5 patterns that show up over and over in how the wealthiest people think about money. Let's walk through them. Secret 1. They don't buy luxury. They buy leverage. From the outside, it looks like they're living large, but when you look under the hood, the habits tell a different story. Most millionaires don't drive brand new cars. Not because they can't, but because they know the second a car leaves the lot, it loses value. They're not interested in the flex. They're interested in the math. They look at lifetime cost, not monthly payments. Fuel efficiency, repairs, insurance, resale value. Those factors matter more than the logo on the steering wheel. They know that every dollar spent on image is one less dollar compounding in the background. And here's what's even more surprising. Many high earners, even those bringing in 6 figures, live paycheck to paycheck. Not because they don't make enough, but because lifestyle creep devours their progress. The upgrades, the subscriptions, the subtle pressure to keep up. It adds up fast. Wealth isn't loud. It's savings that don't get posted. Investments that grow quietly. And liquidity that acts as a safety net when things go sideways. The top 1% aren't trying to win the status game. They're trying to win the time game. And time compounds just like money does. Secret 2. They earn money while they sleep. Here's one of the clearest differences between the average person and the wealthy. The average person works for their money. The wealthy set things up so money works for them. On average, over half their income doesn't come from labor. It comes from systems, dividends, real estate, equity, royalties. The remaining portion? It's earned, then reinvested. This creates a flywheel. Earn, invest, repeat. And the engine never really stops. Contrast that with the paycheck loop most people are in. Money comes in, money goes out. Groceries, bills, subscriptions, impulse buys. Then the cycle resets. The wealthy flip that script. They carve out a portion, even 25%, and push it toward growth. That could mean stocks, business equity, rental properties, or high-leverage skills. But the goal is always the same, to turn capital into cash flow. And timing matters more than amount. Someone who starts investing small in their 20s will often outpace someone who invests more, but later. That's the power of compounding. It's not linear. It's exponential. Ownership is the foundation. The more you own, the less you depend. Businesses, assets, intellectual property. These don't just build income. They build freedom. The top 1% don't rely on one paycheck. They build portfolios that pay them, whether they're working or not. Secret 3. They stick to the boring stuff. This one catches people off guard. We're told that winning with money means spotting the next big thing. Crypto, meme stocks, AI startups. But the top 1%? They're buying what most people scroll past. Legacy companies with durable demand. Index funds that track the entire market. Dividend payers that send checks month after month. They aren't chasing excitement. They're stacking predictability. Because here's the truth. The markets reward patience more than brilliance. People who chase the hot hand often underperform. Not a little, a lot. The wealthy have learned that being consistent beats being clever. They build 3-fund portfolios. They reinvest dividends automatically. They buy companies they actually understand. It's not sexy, but it works. Here's what this looks like in practice. They don't react to news cycles. They don't sell in a panic. They know volatility is the price of admission, and they accept it. Because they're playing the long game. They're not trying to be Warren Buffett. They're trying to build systems that survive market dips, policy shifts, and economic cycles. They want their portfolio to outlast them, not just outperform this year. And when everyone else is panicking, they're buying more. Because they don't need permission to invest. They already know their plan. They've already committed to it. The pattern behind it all. Here's the thread that ties it all together. The wealthy think in decades, not days. They don't need to look rich. They're building quiet stability that gets stronger with time. And that strength isn't found in flashy purchases. It's found in boring systems, disciplined decisions, and financial clarity. They remove emotion from the process. They automate contributions. They track net worth like a business tracks revenue. Most people try to manage their money through willpower. The top 1% build systems so they don't have to. That's the difference. And that's the playbook. Want to apply this? You don't need to make $1 million to start thinking like a millionaire. You need a system. A repeatable, calm, low-drama approach to money. Start with this. Save and invest a fixed percentage before you spend. Own things that grow or pay you. Avoid financial FOMO. Be boring on purpose. If you can do those things consistently, you're already moving differently. And if you keep going, time does the rest. The truth is, the top 1% don't have a secret club. They just stopped playing the short game. Now it's your move. Secret number 4. Automation greater than willpower. If there's one thing the wealthy have figured out, it's this. Systems beat discipline. Most people think the top 1% get ahead because they know more. They don't. They just build better systems, and then get out of their own way. Their financial lives run on autopilot. And that's not accidental. It's by design. Each month, money flows automatically. Investments are funded. Emergency funds are topped off. Essentials and reward budgets are allocated. No manual transfers. No forgotten goals. No emotional tug-of-war about what to do next. Just consistent automatic progress. And that's the key. They've removed emotion from the equation. No second-guessing whether it's a good time to invest. No skipping a month because of impulse spending. No reacting to the headlines. The system runs, even when they don't feel like it. But it goes deeper than just auto-investing. They use tools most people overlook: dividend reinvestment plans, DRIPS, quietly compound returns. Roundup apps funnel spare change into savings. Auto transfers move money the moment a paycheck lands. All of this happens in the background. No friction, no fatigue. And that's the whole point. It's not about being more disciplined. It's about not needing discipline at all. Because willpower fades, systems don't. By automating key decisions, the top 1% free up something even more valuable than money: mental space. They can focus on growing their careers, launching new ventures, spending time on things that actually matter. They've designed a money system that doesn't depend on mood, memory, or motivation. And that system works, whether they're focused or not. Secret number 5. They think in decades, not days. The wealthy don't react. They respond. When markets crash, most people panic. They sell. They spiral. They scroll. But the 1%? They pause. They zoom out. It's not that they're fearless. It's that they've trained themselves to think long-term. Every decision ties back to a bigger vision. Not next month. Not even next year. We're talking 20, 30, 40 years out. They rebalance their portfolios once or twice a year. They ignore the daily noise. They view wealth like a marathon, not a sprint. This shift in mindset changes everything. When you think in decades, you stop chasing trends. You stop overreacting to volatility. You start making decisions that actually last. A 3% savings rate versus a 30% savings rate? Over 30 years, the gap can be millions. Not because one person picked better stocks, but because they played the right game. The 1% aren't obsessed with fast growth. They're obsessed with staying in the game long enough to let compounding do its work. And that creates a calm that's rare. While others stress over red charts, they stay grounded. They see dips as discounts. They buy when others panic. Not because they're contrarian, but because they're prepared. They've already built a plan, one that's based on history, not headlines. And because of that plan, they don't need reassurance. They just stay the course. They know wealth isn't about guessing right today. It's about stacking consistent decisions for decades. They don't waste money on things that won't matter in 5 years. They prioritize stability, not status. And when setbacks hit, as they always do, they don't crumble. They adjust. Because they've factored in uncertainty from the start. They don't expect a smooth ride. They just keep moving forward. They're not chasing quick riches. They're building something that lasts. That's the shift. From chasing dopamine to designing systems. From thinking like a sprinter to moving like a marathoner. And that's how the wealthy stay wealthy. The math that changes everything. Building wealth isn't about earning six figures. It's about what you do with what you already have. Because the truth is, most people don't need more income. They need a better system. A system that gives every dollar a job. That cuts out the chaos. That builds peace, not pressure. One of the simplest, most effective frameworks I've ever come across? The 25 to 15 to 50 to 10 rule. It flips the way most people approach money on its head. Let's break it down. 25%. Growth. This is the money that works for you. Investments in stocks, index funds, real estate, skills, or businesses. Things that grow in value or generate cash flow over time. This is how you build passive income. Not overnight, but month after month. It might be a $100 transfer into your investment account, or a course that boosts your earning power, or a down payment on a cash-flowing rental. Whatever the form, the goal is simple. Turn earned income into owned assets. 15%. Stability. This is your financial armor, a safety net that absorbs the shocks. Job loss, car repairs, medical bills, broken boilers. It's not invested. It's not locked up. It's sitting in a high-yield savings account, ready when life gets unpredictable. 3 to 6 months of expenses. Accessible. Stress-free. Because nothing derails wealth faster than a crisis with no cushion. Stability doesn't sound exciting, but it's the foundation the rest of your financial life is built on. 50%. Essentials. The basics. Rent or mortgage, groceries, utilities, gas, insurance. But here's the catch. This isn't about lifestyle inflation. It's about clarity. That means no takeout 4 nights a week. No streaming services you forgot about. No gym membership you haven't used since February. This is where financial discipline meets awareness. It's not about deprivation. It's about defining what truly matters and cutting the rest. 10%. Rewards. This is the part most people miss. It's guilt-free spending, and it's built into the plan. Vacations, hobbies, nice dinners, new experiences. This is the pressure valve. It keeps you from rebelling against your own goals. When reward is part of the system, you're less likely to sabotage progress. Because enjoyment doesn't have to mean overspending. It just has to be intentional. What makes this work? The reason this framework is so powerful, it's not just about percentages. It's about philosophy. You stop guessing, you stop hoping, and you start directing. Every dollar has a purpose, which means you're no longer reacting to your money, you're leading it. And the beauty of it? You don't need to start big. Start with what you have. Even if you're saving 5%, not 25%, that's fine. The power is in the consistency, not the perfection. As income grows, the framework grows with you. Raises don't disappear into lifestyle creep. They go into your systems. Bonuses become growth fuel, not impulse splurges. Windfalls become wealth, not weekends. This is how momentum is built. This is how wealth becomes a lifestyle, not just a dream. Adopting the 1% mindset. Wealth doesn't start with money. It starts with ownership, not of liabilities, of assets. The 1% live differently, not because they earn more, but because they manage better. Every dollar they earn has a reason to exist. If it doesn't build, protect, or create meaningful joy, it's gone. They build buffers. They automate decisions. They don't rely on willpower. They rely on rules. They filter spending through simple questions. Does this add long-term value? Will this still matter in 5 years? And when the answer is no, they move on. They avoid dopamine traps. They don't chase every new shiny thing. They build habits that scale with them. And most of all, they remember why they do it. Not to flex, not to impress, but to buy back time, to own their calendar, to live on their own terms. Money isn't the goal. Freedom is. You don't have to be born into this. Managing money like the top 1% doesn't require an inheritance. You don't need to win the lottery. You don't need to start the next billion-dollar app. You just need to understand how they think and what they avoid. They don't chase trends. They don't overspend. They don't guess. They automate. They protect the downside. They invest early and often. And they never stop learning. Use the 25 to 15 to 50 to 10 framework. Own assets, not liabilities. Focus on consistency, not hype, and stop trying to look wealthy. Start building something that quietly grows behind the scenes. For decades. If this changed the way you think about money, hit the like button. Leave a comment with your biggest takeaway. And if you're ready to take the next step, check out our full breakdown on how to make your first $10,000 the smart way. It's linked right above. See you in the next one. Charlie Munger once said, "The first $100,000 is a bitch, but you gotta do it." And the truth is, he was absolutely right. The first $100,000 is the hardest, the slowest, and the most mentally draining part of the entire wealth-building journey. If you've reached it, you've already done something that most people will never accomplish. But here's the part nobody tells you. Hitting $100,000 is not the finish line, it's the starting point. Because $100,000 is the moment when your money finally becomes heavy enough to start compounding in a meaningful way. It's when small percentages start turning into big results. It's when your financial decisions suddenly matter more. And it's when you need to shift your mindset from, "How do I save?" to, "How do I grow this intelligently, safely, and aggressively?" So in this video, you're going to learn the 7 specific things you should do the moment you reach $100,000 in savings or investments. Not vague ideas, actual steps. Steps that will determine whether your next $100,000 takes 5 years, 3 years, or 1 year. Because whether you like it or not, what you do with your first $100,000 will make or break your path to $1 million. First, celebrate, but stay humble. This might sound counterintuitive in a financial video, but hear me out. Money is emotional. Discipline is emotional. And reaching $100,000 after years of grinding, budgeting, compromising, skipping nights out, investing consistently, this is a milestone worth acknowledging. Only about 28% of Americans ever reach $100,000 in savings or investments. If you're outside the US, the number is even lower in many regions. So yes, take a moment. Celebrate with a nice dinner. Take your partner or your friends out. Spend $200 to $300 guilt-free. Because this celebration isn't about splurging, it's about reinforcing the identity of someone who sets goals and actually achieves them. But you also need to stay humble. Because that $100,000, it's not spending money. It's not finally I can upgrade my life. No. It's the capital. It's your tool. It's your engine. It doesn't free you to spend. It frees you to build. If you treat it like a trophy, you'll lose it. If you treat it like a foundation, you'll multiply it. So enjoy the moment, but don't loosen your discipline. Most people hit $100,000 and then immediately ruin the momentum by celebrating too big or rewarding themselves with upgrades. New phone, new car, new apartment. You don't need any of that. You need progress. You need consistency. You need to maintain the same mentality that got you here. The dinner is enough. The milestone is emotional validation. The money itself stays untouched. Once you've celebrated, the second thing you need to do is rebalance your portfolio. Up until $100,000, almost anything works. You could be 100% in VOO. You could be 100% in Bitcoin. You could be buying random ETFs, or even making beginner mistakes. Because early on, your contributions matter more than your returns. But at $100,000, the math flips. Your portfolio return becomes more important than your monthly deposit. That means diversification becomes crucial. A smart structure at this level might look something like 60% in VOO, which is $60,000 allocated to large US companies. This gives you long-term stability and exposure to the biggest names in the world: Apple, Microsoft, Amazon, Google. Then 25% in SCHD, around $25,000, which gives you high-quality dividend-paying companies. This smooths your returns and starts generating passive income. Then 10% in VXUS, about $10,000, because international diversification helps hedge against US concentration risk. And finally, 5% in individual stocks or high-conviction plays, $5,000 for companies you've researched and genuinely believe in. Not hype, not pump and dumps. Real companies with strong earnings and long-term potential. At $100,000, rebalancing means protecting your downside while still keeping aggressive exposure to growth. If you stay 100% in one fund, one sector, or one asset type, you're gambling. Diversification isn't about maximizing return. It's about making sure nothing destroys your progress. And if you're thinking, but I like my current allocation, remember, emotional attachment is the enemy of wealth. Rebalance. Get organized. Build a portfolio that's designed for the next $900,000, not the first $100,000. After rebalancing, it's time for step 3. Maximize your tax-advantaged accounts. Taxes are one of the biggest killers of wealth. And the earlier you optimize for taxes, the more money you keep long-term. Think of your portfolio split like this: $50,000 in a Roth IRA, $40,000 in a 401k, and $10,000 in a taxable brokerage. Why prioritize these? Because a Roth IRA grows completely tax-free. That means if your $50,000 becomes $500,000, you keep every dollar. No capital gains tax, no income tax, nothing. It's free money. A 401k gives you tax deductions today, lowering your taxable income. If your employer matches your contributions, that's literally a 100% return instantly. And then the taxable brokerage is for flexibility. You use it for investments you might need to touch earlier or for strategies that don't fit inside retirement accounts. Maximizing tax-advantaged accounts could easily save you over $150,000 over your lifetime. That's not an exaggeration, it's math. Taxes compound just like returns. So the more taxes you avoid now, the more your money snowballs later. If you've never optimized this before, your $100,000 moment is the time to start. Now let's talk about step 4. Building passive income streams. At $100,000, passive income finally becomes meaningful. With a 3% yield, $100,000 generates about $3,000 a year, $250 per month. But if you structure it smartly, you can actually increase that. For example, you could build a diversified income mix like 20% in JEPI for high yield. This gives you around an 8% yield. So $20,000 in JEPI gives you about $1,600 per year. Then 30% in SCHD or dividend aristocrats like O or J&J. These give you around 3.5%. That's roughly $1,050 per year. And the remaining 50% in VOO gives you around 1.5% yield, which is about $750 per year. Combined, that's roughly $3,400 per year, or $283 per month. This won't replace your job, but it will change your psychology. The moment your money starts paying you, even a small amount, everything becomes real. You think differently. You invest differently. You protect your portfolio differently. The key is, don't reinvest passive income into lifestyle upgrades. Reinvest it back into your portfolio until it becomes large enough to matter. The people who build real wealth don't spend their passive income in the beginning. They multiply it. Step 5 is all about protecting your wealth. At $100,000, you're finally at a point where you have something worth protecting. That means reviewing your insurance policies, health insurance, renter's insurance, disability insurance, if your job depends on your ability to work. You need to update your beneficiaries so your money goes to the right people if something happens to you. You need to maintain an emergency fund, at least $10,000 to $20,000 in cash, not invested, not touched, ready for anything. And you need to lock down your digital security. Turn on two-factor authentication on all financial accounts. Use a password manager. And if you have dependents or significant assets, consider a basic estate plan. Not because you're rich, but because planning early prevents chaos later. Wealth isn't just about making money. It's about making sure you keep it. Step 6. Avoid lifestyle inflation. This is the silent killer of wealth. Most people hit $100,000 and instantly start upgrading their life. New apartment, new car, new vacations, new wardrobe. But every upgrade increases your baseline expenses, which makes it harder to save and invest. A $20,000 car upgrade today doesn't just cost you $20,000. If you invested that money instead at an average 9% return, it becomes $52,000 in the future. Every lifestyle decision has a compounding cost. The trick is simple. Keep your life exactly the same for as long as possible while your investments grow behind the scenes. If you avoid lifestyle creep between $100,000 and $500,000, you will reach $1 million faster than you ever imagined. Wealth is built by quietly living below your means while your portfolio compounds loudly in the background. Step 7. Set your next milestone. $100,000 is great. But without a next goal, your discipline collapses. Your next goal should be $250,000. Why? Because it's achievable within 5 to 7 years if you invest around $1,500 per month. And once you hit $250,000, reaching $500,000 takes only 5 to 6 years. Then, $500,000 to $1 million? About 6 to 7 years with the same contributions. The higher your net worth goes, the faster the next milestone arrives because compounding accelerates. Your job is to stay consistent long enough for compound interest to take over. Before we wrap up, let's zoom out and look at the compound effect of your first $100,000. If you leave that $100,000 invested and it earns a 10% annual return, here's what happens. After 5 years, it becomes $161,000. After 10 years, it becomes $259,000. After 15 years, it becomes $418,000. After 25 years, it becomes over $1,080,000. Your first $100,000 becomes $1 million, even if you never add another penny. That's the magic of compounding. That's why Charlie Munger emphasized the first $100,000 so much. It's not because $100,000 makes you rich. It's because $100,000 is the moment compounding becomes unstoppable. Let's go even deeper, because reaching $100,000 doesn't just change your bank account, it changes your identity. And if you're not careful, the world around you will try to pull you back to your old habits. When people around you notice you've become financially responsible, they'll react in different ways. Some will be inspired. Some will feel threatened. Some will suddenly ask for advice. Others will try to get you to spend more so they feel better about their own lifestyle. But the truth is this: your financial journey is yours alone. And the moment you hit $100,000, you step into a different category of people. People who no longer think like consumers, but like builders. And builders move differently. This is why the next phase of your journey requires one more crucial shift. You have to upgrade your environment. Not your house, not your car. Your environment. The people you listen to, the content you consume, the habits you surround yourself with. Because your mindset will determine whether your $100,000 becomes $200,000 or whether you stay stuck at the same level for the next decade. If you keep spending time with people who normalize debt, who always complain about money, who constantly chase the next impulse purchase, your financial habits will slowly drift backward. Not instantly, slowly. Comfortably, silently. And one day, you'll look at your portfolio and realize you haven't made progress in years. Protect your environment like you protect your investments. The people around you don't need to be rich. They just need to be disciplined, optimistic, forward-thinking, and aligned with growth. Another thing most people never talk about after reaching $100,000 is emotional detachment. When you're new to investing, every market dip feels personal. Every correction triggers fear. Every red day feels like a setback. But at $100,000, volatility becomes part of your weekly reality. You'll see your portfolio drop $3,000 in a day, sometimes $5,000, sometimes more. And if you're not emotionally prepared, it will feel like the sky is falling. This is where emotional maturity matters. You need to understand that the market doesn't care about your feelings. Volatility is the price you pay for growth. And the moment you can watch your portfolio fluctuate by thousands without panicking, without selling, without changing your strategy, that's the moment you're ready for the next level of wealth. Because millionaires don't get there by avoiding volatility. They get there by staying calm while everyone else panics. And speaking of the next level, you need to start thinking long-term in a deeper way. Up until $100,000, your horizon might have been 3 to 5 years. But real wealth requires 10-year thinking, 20-year thinking. When you look at your portfolio, you shouldn't be asking, what will this be worth next year? You should be asking, what will this be worth when I'm 40, when I'm 50, when I'm ready to stop working? Because the difference between someone who stops at $200,000 and someone who reaches $2 million isn't intelligence or luck. It's time. Time is your silent partner. Time is the amplifier. Time is the multiplier. But time only works if you stay consistent. And consistency only works when you zoom out. You have to detach from short-term noise so you can execute long-term strategy. Another thing you need to start doing after hitting $100,000 is building optionality into your life. Optionality means having choices, the ability to say no, the freedom to walk away. Money buys freedom long before it buys things. So ask yourself, if something happened tomorrow, your job changes, the economy shifts, your interests shift, do you have options? Does your savings give you breathing room? Does your portfolio give you flexibility? Because $100,000 is the first time in your life where money starts giving you leverage. Not against people, against circumstances. You can negotiate harder. You can change careers. You can take a risk. You can invest in yourself. You can protect your future. Most people treat money like a decoration. You need to treat it like a shield and a sword. This is also the moment where you should start tracking your progress more seriously. Not obsessively, not daily, but meaningfully. Create a simple system to track your net worth every month. Look at your investments, your liabilities, your savings rate, your debt if you have any. Because what gets measured gets improved. And when you start tracking your progress, you'll notice something amazing. Even when life feels chaotic, your net worth will quietly increase behind the scenes. And that's one of the most addicting feelings in personal finance. The steady upward curve created by consistency. But remember, consistency doesn't mean perfection. You will have months where you save a lot and months where you save nothing. That is normal. The goal is direction, not perfection. As long as the trend is upward, you're winning. And finally, once you reach $100,000, you need to redefine what success looks like. Not in the eyes of society. Not in the eyes of your friends, in your own eyes. Do you want financial independence? Do you want a comfortable life? Do you want freedom to work on what you love? Do you want to retire early? Your financial plan needs meaning behind it. Money without purpose becomes wasted potential. Money with purpose becomes a roadmap, a strategy, a mission. Your mission might be helping your family, building generational wealth, buying your first home, traveling the world, or simply living stress-free. Whatever it is, anchor your financial decisions to that mission. Because the more personal your goals are, the more motivated you'll be to stay consistent. Imagine waking up 8 years from now with the freedom to never work another day unless you want to. No alarm clock, no boss, no commute. Just a life you intentionally designed. Now here's the real shocker. You don't need a trust fund, a high-paying job, or a head start. You can begin with nothing. Literally zero. The only thing you actually need is a plan, one that's realistic, aggressive, and proven to work. And before you say, that sounds impossible, let me ask you something. Why do we assume retiring early requires luck, when in reality it requires something far more predictable, math and discipline? People underestimate what they can do in 8 years and overestimate what they can do in 1. So today, I'm going to walk you through the exact year-by-year blueprint I would follow if I had to retire in 8 years starting from nothing. No fluff, no fantasy, just the strategy. But before we begin, ask yourself this. If you lost everything today, your savings, your investments, your job, would you know how to rebuild it all from scratch? Because that's the question this plan answers. And if your answer was no, by the end of this, it will be yes. When you're starting from zero, the first year isn't about becoming rich. It's about becoming dangerous. You need to develop the kind of financial habits that turn someone with no money into someone who gets rich systematically, month after month. And trust me, the fastest way to build wealth isn't through some magical stock pick. It's through cash flow. You need income, and not just enough to survive. You need enough to invest aggressively. But here's where most people go wrong. They think increasing income requires getting a better job. That's outdated thinking. The fastest way to increase income in 2025 is through skill stacking. One high-value skill won't transform your life, but 2 or 3 combined can double your income in less than a year. Copywriting, plus social media management. Sales, plus short-form video editing. Graphic design, plus email marketing. You don't need a 4-year degree. You need 30 days of focused effort. Spend the first year building one skill that pays at least $20 to $30 per hour, and another skill that lets you sell that first skill at scale. While you're doing that, you need to solve the biggest enemy of early retirement: lifestyle inflation. The truth is, Most people don't stay broke because they don't earn enough. They stay broke because every time they earn more, they spend more. If you want to retire in 8 years, you have to fight the instinct that tells you to upgrade your life every time your paycheck increases. Instead, you need to do the opposite. You must keep your expenses flat while your income rises. That gap, the stretch between what you earn and what you spend, is the fuel for everything that follows. If you can create a gap of even $1,000 a month by the end of year 1, congratulations, you've built the single most important foundation for early retirement. Year 2 is where most people quit. You're not rich yet. Your investments aren't big enough to excite you. But this is where the magic begins. Because year 2 is about turning your income from linear to exponential. That means building offers. You're no longer the person who charges per hour. You're the person who charges per solution. Instead of editing videos for $20 an hour, you deliver content packages for $800. Instead of doing design per project, you offer monthly retainers for $1,500. Instead of applying for jobs, you build your own income machine. When your income jumps, your investment power jumps. And by this point, you must ruthlessly automate investing. I'm talking about automatic transfers into ETFs every month without fail. This plan doesn't work if you invest when you remember. It works when you invest because you have no choice. Not emotionally, not mentally, but mechanically. By year 3, something spectacular happens. Your investments start earning more investment growth than your first-year contributions. This is the moment when compounding officially joins your team. You're still working hard, but now your money is working harder. And this is when you start thinking about diversification. No, not 60 different assets. I'm talking about a simple 3-core system: broad market ETFs, cash-flowing digital skills, and one scalable income stream. This 3-legged structure is indestructible. You could lose your job. You could get sick. The economy could crash. But with diversified income and diversified investing, your plan stays intact. By year 4, you should have a minimum of 2 streams of income and around $50,000 to $80,000 invested, depending on how disciplined you've been. And this is where your identity starts shifting. You're no longer working toward retirement. You're actually building it. You're not dreaming about freedom. You're manufacturing it. You start realizing you don't need $1 million to retire. You just need enough invested to cover your lean expenses with passive income. And if you've kept lifestyle inflation under control for 4 years, those expenses are still extremely low. This makes the finish line so much closer than people think. By year 5, debt is the enemy, but leverage becomes a tool. This is the year many people decide to invest in real estate if it makes sense for their country. But even if real estate isn't an option, you expand your investment contributions as your income continues to grow. You increase your monthly investments, automate savings, and start building a safety net. Because contrary to what motivational videos say, quitting your job blindly is not brave, it's irresponsible. True freedom requires a foundation that can withstand stress, uncertainty, and time. Year 6 is where most people lose focus. They start making comfortable money. Their investments have grown. Their income is higher than they ever imagined. Suddenly, friends are upgrading their cars, their apartments, their wardrobes. And this is where discipline becomes a superpower. You have to say no to fake wealth, so you can say yes to real wealth. You don't need a luxury lifestyle. You need a powerful portfolio. You don't need a new car. You need a larger investment contribution. Every sacrifice you make here will reward you 10 times more in the future. Because in year 6, compounding stops being slow. It starts accelerating. By year 7, your investments should be generating more passive income than you earned in your early 20s. You notice that your net worth grows even when you're not actively adding to it. You realize that you could survive for months, maybe years, without working. And for the first time, early retirement becomes real. Not theoretical, not motivational, real, tangible, measurable. Your financial runway lengthens every month, and the fear of losing your job disappears completely. Money is no longer something you chase, it's something you control. Then comes year 8, the year when the question becomes simple. Do you want to stop working, or do you want to keep going? Because by now you have 2 options: retire early and live minimally, or keep working 1 or 2 more years and retire abundantly. Either way, you have built something almost no one ever manages to build. Choice. You can choose how you spend your time instead of selling it. You can choose projects instead of needing a paycheck. You can choose freedom instead of obligation. And that's what early retirement actually is. Not never working, but never being forced to work. The truth is, retiring in 8 years with nothing is not just about money. It's about behavior. It's about the courage to stay consistent when progress feels slow. It's about avoiding the traps that keep most people working until they're 65. Debt, lifestyle inflation, poor financial habits, and lack of vision. You don't win this game by being smarter. You win by being consistent. You win by making decisions based on math, not emotions. You win by building income first, investing second, and increasing lifestyle last. If there's one thing I've learned from studying people who retire early, it's this. They are not lucky. They are not gifted. They are not born financially special. They are simply people who stayed the course. They put their financial goals above short-term pleasures. They put their financial goals above short-term pleasures. They understood that freedom requires sacrifice, and they accepted that the price of discipline is far cheaper than the price of regret. And if all that wasn't already enough to rethink everything you believed about retirement, here's the part most people completely overlook. The emotional shift that happens once you actually start seeing your investments work for you. In the beginning, when you're saving aggressively, every bit of money or dollar feels like a sacrifice. It feels like you're giving up fun, comfort, and convenience. But once that first year passes and you look back and see real money, real growth, you suddenly understand why people call investing addictive. Because nothing compares to the feeling of watching your money make more money without you lifting a finger. Over the next few years, the person who once struggled to save even a tiny amount becomes the person who confidently sets aside 40 to 60% of their income. Not because they're forcing themselves to, but because they finally see the reward. The moment your investment returns become bigger than your monthly contributions, the game changes. You no longer feel like you're grinding for money. Your money is grinding for you. And once you taste that feeling, you want more of it. That's why the 8-year retirement plan works so well for ordinary people. It's built on momentum, not miracles. By year 4 or 5, something even more interesting starts happening. You begin making decisions differently. Instead of buying something impulsively, you automatically calculate the opportunity cost. You start asking yourself, is this worth delaying my freedom? And most of the time, the answer is no. You buy fewer things, but better things. You stop trying to impress people who don't matter. You stop competing in lifestyle games that no one ever wins. You realize the real flex isn't a fancy car or a designer watch. It's waking up with full control of your time, every single day. And here's a truth many people ignore. Throughout those 8 years, you become a completely different version of yourself. Financial independence isn't just about money. It forces you to build discipline, patience, and clarity. It forces you to learn skills, negotiate salaries, manage emotions during market dips, and navigate uncertainty. By the time you hit year 8, the person you've become would be unrecognizable to who you were at year 0. And that transformation is just as valuable as the money itself. But the real test happens after year 5. This is the phase where most people either accelerate dramatically or get stuck. Because this is where investing feels slow again. You've made a lot of progress, but you're not free yet, and the finish line still looks far away. This is the point where people get tempted to take a break or loosen their habits. But in reality, these middle years are where the magic happens. The compounding hits its stride. The seeds you planted years ago begin to grow exponentially. Every decision you make during this period determines whether you'll retire early or delay your freedom for another decade. The people who succeed here are the ones who treat their plan like a mission. They automate everything. They avoid lifestyle creep even when they get promotions. They use every new skill to increase income rather than increase expenses. They make their investment contributions non-negotiable, like paying rent or electricity. They understand that consistency is more powerful than intensity. And most importantly, they remember that the purpose of money is to buy time, not things. By year 8, a strange shift happens. You realize you don't even need to retire anymore. Because you've built so many skills, so many income streams, and such strong discipline that work no longer feels like a burden. You have the option to quit, but also the confidence to continue on your own terms. And that's the real freedom. Not escaping work, but escaping forced work. Doing work because you choose to, not because you're trapped. What most people don't realize is that the plan isn't just numbers on a spreadsheet. It's a philosophy. It's about designing a life where your money works harder than you do. It's about removing financial anxiety forever. It's about never being in a position where one job loss or one emergency can destroy your stability. And it's about giving yourself the freedom to pursue your passions, even if those passions don't pay immediately. Another thing that becomes clear during this journey is how much your social circle affects your money. When you're surrounded by people who constantly upgrade their lifestyle, take unnecessary EMI payments, or spend half their salary on impulse purchases, it becomes almost impossible to stay disciplined. But when you're around people who think long-term, people who talk about investing, income growth, skill building, and financial freedom, your mindset shifts naturally. You become more intentional, more strategic, and more focused on the bigger picture. And somewhere along this journey, you stop seeing money as something to use for validation. You stop caring about trying to look rich. You focus on becoming stable, resilient, and independent. You understand the difference between being rich and being wealthy. Rich people look wealthy. Wealthy people are wealthy. Rich people chase luxury. Wealthy people chase freedom. Rich people show off. Wealthy people disappear. The beautiful irony is that once you achieve true financial freedom, you suddenly gain the ability to afford the very things you once denied yourself. But by then, you no longer need them. Because the satisfaction of living life on your terms is far greater than any material purchase. And even if you do decide to buy something, whether it's a nice car, a vacation, or a new gadget, you buy it from a place of abundance, not insecurity. You buy it because you want it, not because you're trying to impress anyone. And that's why this plan works for the average person better than anything else. It's simple. It's realistic. It's practical. It doesn't depend on economic miracles or lottery wins. It depends on something far more powerful: your ability to show up every day for your future self. Because at the end of the day, retiring early isn't a dream. It's a decision. So if you want to retire early, if you want to build wealth from nothing, understand this. Your starting point doesn't matter. Your past doesn't matter. Your mistakes don't matter. 8 years is enough to change everything. And whether you start today or not, 8 years will still pass. The difference is whether those 8 years leave you exactly where you are now, or financially untouchable. And if you follow this plan, year by year, month by month, dollar by dollar, the outcome becomes inevitable. Not because of luck, not because of talent, but because you designed your future with intentionality. And once you build that kind of momentum, once compounding joins your side, once your income rises beyond your expenses and your investments grow beyond your expectations, you won't just retire early. You'll retire powerfully. There's a certain quiet panic that creeps in when you realize you're behind. It's not loud. It doesn't come all at once. It arrives slowly, like fog rolling into a valley. Subtle at first, then suddenly you're surrounded. Maybe you're 25, maybe you're 35, maybe you're 45. You wake up one day, look at your bank account, and realize something simple but terrifying. You have nothing invested. No assets, no portfolio, no passive income. You're working for every dollar, and every dollar is already spoken for before you even earn it. Rent, food, gas, insurance, life. Now imagine this. It's November 2025. You have $0 invested, no savings to speak of, no employer match waiting to be claimed, no stock portfolio, just a checking account with your name on it and a decision to make. This isn't a hypothetical. This is real life for millions of people. And if that were me, if I was starting completely from scratch in 2025, This is exactly what I do. Step by step, no fluff. Because I've studied this, lived through versions of this. And if there's one thing I've learned about building wealth from zero, it's that the hardest part isn't finding the right ETF. It's not even saving the first $1,000. The hardest part is starting it all. Let's start at the very beginning. I'm sitting in my apartment. Rent is $1,450. My paycheck hits every 2 weeks. Just enough to cover my essentials, maybe with a few hundred left over if I'm careful. No help from parents, no windfalls. Just me, trying to figure out how to not work for every dollar forever. So before I even think about investing, I need to do one thing: get a handle on my cash flow. I start by tracking every expense. And I mean everything. Not just rent and groceries, but the little stuff. The $4 coffee, the $12 Netflix subscription, the spontaneous Amazon orders. I go through my bank statements line by line, because I need to see where my money is actually going, not where I think it's going. After a month of brutally honest tracking, I find out something painful. I'm spending $400 a month on stuff that adds zero long-term value. Fast food, streaming, random upgrades I don't need. That's my margin. That's where I start. So now I've freed up $400. That's not much, but it's enough to begin. But even before I touch the market, before I think about stocks or ETFs, I build my safety net. Because investing with no emergency fund is like skydiving without a parachute. Sure, the views are great until something goes wrong. And something will go wrong eventually. So here's my goal: save 3 months of expenses in a high-yield savings account. If my monthly expenses are $2,500, that means I need $7,500 saved. It sounds like a lot. Because it is. But I treat it like survival. I don't see it as optional. And I definitely don't touch the stock market until I hit it. This emergency fund isn't for fun. It's not for investing. It's for keeping me from panic selling the moment my car breaks down or I lose my job. So I open a savings account, somewhere like Marcus, Ally, or Wealthfront, all offering around 4.5% APY right now. That means my cash won't lose too much to inflation while it sits. Now, I grind. I save $1,000 a month if I can. Maybe more, maybe less. But I keep saving until I hit that $7,500 mark. If it takes 6 months, so be it. I know this phase is temporary but necessary. And when I hit it, when that account finally reads $7,500, something inside me shifts. I feel calmer, clearer, more ready. Because for the first time in a long time, I'm not in survival mode. I'm not praying my paycheck clears before the rent is due. I'm not hoping the tires on my car don't go flat, or that I don't get sick, or that the fridge doesn't die. I have margin. I have room to breathe. This account isn't exciting. It doesn't jump 10% in a day. It doesn't go viral. But it gives me something better. The freedom to not panic. The space to make long-term decisions without fear dictating every move. And that's rare. Most people never get here. Not because they can't, but because they underestimate how powerful peace of mind actually is. I used to think investing was about growing wealth. Now I realize it's just as much about reducing anxiety. Money you don't need today gives you confidence about tomorrow. And that confidence, it's compounding too. It affects how you show up at work, how you sleep at night, how you respond to setbacks. It's not just a number in an account. It's the mental bandwidth to think beyond next week. And once you've tasted that feeling, you never want to go back. So I sit with it. I let that first win settle in. It's small in the grand scheme, just $7,500. But it's more than I've ever saved, and it changes everything. Now, I invest, but not randomly. I start with the most powerful tool available to everyday investors, the Roth IRA. In 2025, the contribution limit is $7,000. That means I can contribute up to $7,000 of my earned income each year, and all of it grows tax-free. That's not a glitch. That's the rule. You pay taxes now, never again. And that's huge, because future me, the one who's 55 or 65, will thank me for every dollar I invest today that compounds without ever being taxed again. I open my Roth IRA with Fidelity. It's beginner-friendly, intuitive, and offers fractional shares. Vanguard and Schwab are great too, but Fidelity is the most accessible for someone just getting started. Now comes the moment of truth. My first investment. I put my first $1,000 into VOO, the Vanguard S&P 500 ETF. Why? Because it gives me immediate exposure to 500 of the best, most profitable companies in the United States. Apple, Microsoft, Amazon, Google, JP Morgan, Procter & Gamble. They're all in there. I'm not trying to beat the market. I'm trying to own the market. VOO trades around $450, but because Fidelity offers fractional shares, I can buy exactly $1,000 worth. No need to buy full shares. That first investment feels different. It's not just numbers on a screen, it's a signal to myself, a shift in identity. I'm no longer just a consumer of the economy. I'm now a partial owner. When Apple sells another iPhone, I get a sliver of the benefit. When Microsoft signs another enterprise contract, a piece of that value trickles to me. I've crossed a line, from outsider to participant. It doesn't matter that it's only $1,000. What matters is that it's real. It's invested. It's working, even when I'm not. This money has left the world of static savings accounts and entered a dynamic ecosystem that grows while I sleep. And that's powerful. For years, I thought investing was something rich people did, something complicated, intimidating. Now I realize it's just action. One transfer, one decision, one click that rewires how I see the future. And VOO is the perfect place to start. It's not flashy. It's not speculative. It's not some hot tech stock that might triple or crash. It's a quiet machine, designed to mirror the backbone of the American economy. It doesn't need to hit home runs. It just needs to keep showing up. Over time, it wins through consistency, just like I plan to. I used to scroll past stock charts like they were some foreign language. Now I watch VOO move and understand that every dip is a sale, every gain a signal. I don't panic, I don't chase, I buy and I hold, because that's what ownership looks like. And with that first $1,000, I've taken the most important step. I've begun. That first buy feels electric. It's not about the amount, it's about the act. I've officially stopped being a spectator and become an owner. Now I automate everything. I set up a recurring $500 transfer from my checking to my Roth IRA every month. I tell it to auto-buy VOO with every deposit. I don't touch it. I don't tinker. I just let it run. 3 months in, I've contributed $2,500 and I start to see some gains. Maybe it's only $100, maybe less. Doesn't matter. I've planted the seed. After 3 months of investing solely in VOO, I start to diversify. Now my monthly $500 contribution is split 3 ways. $300 still goes to VOO. That's my core. $150 goes into SCHD, a dividend-focused ETF with a strong yield, historically over 3%. $50 goes into a single, boring, blue-chip stock, something like Coca-Cola. Why? Because I want to start learning how individual companies behave. At this point, I don't chase trends. I don't try to outsmart the market. I'm building muscle memory, the habit of investing consistently, automatically, without emotion. 12 months in, I've invested $6,000. My account might show $6,400, maybe $6,600. That's not life-changing money yet. But it's proof of concept. It's working. Now it's year 2. I've gotten more confident. I've read a few books, watched a few too many investing videos, maybe started following earnings reports. And I decide to level up. My monthly contributions jump to $750. Now I'm spreading that across more assets. Still heavy in VOO and SCHD, but now I add Johnson & Johnson, Procter & Gamble. Maybe even JEPI, a higher yield ETF that gives me consistent income. By the end of year 2, I've contributed around $15,000. My portfolio might be worth $16,500, not because I got lucky, but because I stayed consistent. The dividends are starting to grow too. $400, maybe $500 a year. That's enough to pay for groceries 1 month, or a car insurance payment. And the best part? I didn't have to lift a finger. The dividends showed up quietly, automatically, like a paycheck I didn't earn, but definitely deserved. Years 3 to 5 are where everything changes. I'm now contributing $1,000 a month. That's $12,000 a year. I've simplified my life to make it work. I drive the same car. I live below my means. I keep my expenses flat even when my income goes up. By year 5, I've contributed $35,000 to $40,000. But my account shows $50,000, maybe more. The market did its thing. My dividends are over $1,200 a year now. Every quarter, new shares appear in my account, bought with the dividends I didn't even touch. This is the beginning of the snowball, and once the snowball starts, it doesn't stop. Now I see the magic of long-term investing. Now I understand why wealthy people get wealthier, not because they work harder, but because their money never stops working. By year 7, I'm pushing $75,000 invested, maybe $80,000. The dividends alone are generating $2,000 to $2,500 a year. That's like working a part-time job I don't have to show up for. By year 10, it's 2035 now, I've crossed $100,000 invested. But my portfolio value? $120,000. Maybe $130,000 depending on how the market's been. My dividends are closing in on $4,000 a year. That's $333 a month showing up without me doing anything. That pays for groceries. It pays for a car payment. It pays for peace of mind. And here's the thing nobody tells you. This part is the easy part. Because once the snowball gets big enough, it rolls downhill on its own. You don't have to push anymore. Just keep showing up. Now imagine this. I keep going. I stay the course for 20 years. I don't try to time the market. I don't panic sell during crashes. I just keep buying. Every single month. By 2045, I'm sitting on a portfolio worth $400,000 to $500,000. Maybe more. My dividends alone are paying me $15,000 to $20,000 a year. That's $1,500 a month, just for showing up consistently and letting time do the heavy lifting. That's what I'd do if I started investing in 2025 with $0. No shortcuts, no crypto moonshots, no options trading, just discipline, automation, and compound interest. The truth is, most people never get here. Not because they're not smart enough, but because they don't start. Or they start, then stop. Or they chase excitement instead of building wealth. So if you're listening to this and you haven't started, don't wait. The perfect time to invest isn't when the market is calm. It's not when the Fed cuts rates. It's not when you get a raise. The perfect time is when you decide to start. Even if it's just $50. Even if it's just one share of VOO. Start today. Start small. Start broken if you have to. Because 10 years from now, the only difference between you and someone with a 6-figure portfolio is whether you showed up consistently or not. The market doesn't care about your excuses, only your participation. Let that sink in and get started. Like, share and help someone else take the first step too.